Hello everyone, welcome back to Upside Down Data. Today I want to talk about risk in the stock market, particularly the S&P 500, and compare where we are right now to other times in the past in the S&P 500 and what it might all mean in the context of the recent 8.6% CPI print that we got this morning. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So today I want to talk about the stock market, a bit of a departure from our usual crypto coverage, but of course, because crypto has been so heavily correlated with the stock market recently, I think it makes a lot of sense to get an idea of what's the stock market doing. Is the stock market likely to fall off a cliff, to keep on crashing? Because if the stock market's not doing well, at least recent history would suggest, crypto is not going to do well either. And so really, for those of us who are hoping that the crypto markets are able to recover soon, we kind of also need to hope that the stock market's able to recover soon as well. Risk assets, at least right now, kind of are going together. So what I'm going to do first is talk about our risk indicator, the upside downside potential indicator, applied to the S&P 500. So this is a different application of this model that we usually talk about. Usually we apply this to crypto assets, but we can actually apply it to the stock market, and I think it shows some interesting results. So here I have the S&P 500 price data ever since the early 1940s. I decided to exclude data before the Great Depression and before that, just because I personally view that as probably being less diagnostic of more recent action. Some people might disagree. Some people think we're about to go into something like what we saw with the Great Depression, but that's just a choice that I've made. Really, when you leave that data in there, the UDPI kind of gets traumatized from experiencing that. You know, it learns from that data, and then it kind of skews its interpretation of everything else because it's so worried about the depression happening again. So I've just chosen to cut the data off here and just have the model trained on the data after that. Again, that was a choice I made. Some people might disagree, but that is how I chose to do this analysis. And so this is just the risk level. So -5 being high risk, -5 low risk, overlapping the S&P 500 value across time. And what we can see is that it does do a pretty good job of quantifying these high and low risk points in the stock market. And one of the things that you probably stood out quite heavily, and actually we talked about this several months ago when I put out the last video about the S&P 500 UDPI, was that we were in the red. We were in a high risk zone, and now we're actually falling out of that. We're falling back down here, as you can see, into the orange, which is a level that we had been sustaining regularly before then in this bull market we've had ever since the 2008 market crash or the great financial crisis. So what I want to do first is just compare where we are right now to times in the past and see what this might look the most similar to the degree that it can look similar to anything. So going up and hitting the red. Well, there are a few times that we can look at where this has happened. You know, certainly right here at the beginning, hit some red, had a little correction going down. Then going into the late 50s, early 60s, we had this whole series of kind of bunny hills where we would go into the red, back down into the orange or yellow, up to the red, back down to the orange, red, orange, yellow, you know, red, etc. Until we got into the kind of high inflation period in the 70s and then early 80s, where more or less we were just kind of hanging out in this actually generally on average lower risk period, before then starting this whole kind of big bull market with this you know, the crash that happened in 1987 kind of mixed in the middle. The one point in here where we hit red, had a correction off of that, and then going into the dot-com bubble burst that happened here in the early 2000s. You'll see that really throughout the latter half of the 90s, we spent a lot of time in the red, and we were actually able to sustain it for a long time, for years. And that's one of the things I talked about back here, was that just because we had hit red didn't necessarily mean we had to just correct immediately, because we've seen an example in the past where it's been able to sustain high risk levels for a long time. But it looks like what we're getting right now might be more reminiscent of what we've seen in this period of time here before, where we go up, we hit the red, and then we actually have a correction soon after that pulls us back down to a lower risk level where we can find a bottom, and then we're able to start moving back to the upside after that. So I'm going to switch views here, look at the raw output of the model, and then just have the S&P 500 value here in yellow overlaid on top. You just see a little bit more closely what's going on. And so really kind of throughout this whole bull run, you'll see the risk kind of generally rising with some variability, generally falling in this bear market that we had back here, or at least this kind of more sideways choppy time in the market from during really the pretty much the entirety of the 1970s. And then we again charted a course up, had some volatility, really dumped heavily in the 2008 crash, and then now we were sitting a lot up in the more positive values on risk. Now, one thing that's really important to note about the stock market relative to crypto is that with crypto, volatility tends to be explosive to the upside and kind of more slow to unwind back to the downside. That's kind of the signature of a lot of crypto assets, right? It's really explosive moves to the upside, and then bear markets that follow. But if you look at Bitcoin, for example, its bear markets tend to play out, the downside moves tend to play out over a longer period of time than those upside parabolic rallies. So the explosive volatility in crypto is to the upside. But in the stock market, it's actually the opposite. The explosive volatility tends to be to the downside. You'll see that you'll get this kind of steady up and then just big explosions to the downside that happen every once in a while. These big just kind of crash events that happen that really tank the price, and then steady slow moves to the upside. And that's partially why we see a UDPI signature that looks like this relative to what we're used to seeing in crypto. You know, in crypto, the UDPI will tend to spend a lot of its time down at 0 or below 0 with just big parabolic moves to the upside, spiking the risk level. The stock market is actually a bit of the opposite, where we're spending actually a lot of the time in these higher risk levels above 0 with these kind of bigger pushes back down below, this kind of explosive volatility to the downside. And so really, when you're looking at the UDPI value, it's a little bit relative to the asset and what do you expect in its volatility, right? Some assets are simply able to maintain elevated risk levels for a long time, like the stock market. Because really what this is saying, what this means is that the stock market is just realizing a lot of its realistic upside potential, and it's just able to continue doing that. And it really only seems to become a problem with the stock market when you get a little bit too elevated, when you get up to some of these higher risk levels. You know, for example, 3 has offered this point where oftentimes when you touch above that, before too long, you're going to have a correction, right? Sometimes you're able to continue going higher, but 3 is offered kind of an important level, with really the big outlier being this big run that we had here in the late 90s. And then we also sustained a little bit longer after passing through that, coming out of the March 2020 crash before falling back down below it. But it seems like for the stock market, you know, this is one level that's been important throughout its history. And then to the downside, you know, 0 is actually offered, you know, or between, you know, 1 and 0 is also offered some support as we come back down, and then we find some support at it again, and we really were bouncing around it a lot during this whole kind of secular bull market that we had coming out of the 2008 crash. Really kind of this general zone being our bottoming out points at these different periods in time before, you know, ultimately went and shot up over 3. So that's, I think, the look that an interesting look for the UDPIs. It just gives us a sense of what we're doing right now relative to the past, where currently it seems like we've gotten back into the kind of zone that we had been back here in terms of the risk level, right? We've come up, bounced off of 4, and are now pushing back down to the downside. Not too similar, dissimilar from the kind of behavior we saw back here. And so I think we just look at this from a color-coded perspective. There's a lot of similarity to this point in the stock market here. And I think this is actually what a lot of people have been calling for as well, this idea that we might just have a lot of volatility for a while in the market, where every time we kind of push back to the upside, we then go back down, kind of this choppy price action, which if we follow this blueprint would still be a general uptrend, but just with quite a bit of volatility, you know, a lot more volatility than we've seen ever since 2008, but still an uptrend. You know, the other possibility would be this kind of action, although, you know, the signature of the UDPI looks different from here. Not that this couldn't play out, that we'd have this literal sideways action, but this is what, you know, is kind of striking me as being the most similar time to where we are right now, looking back to the past. And one other thing that's kind of similar here is kind of getting up to this point was when inflation started, really kind of the early point of when the warning signs were coming, with then inflation really manifesting itself in the 70s. You could argue that's similar to where we are today, with inflation now starting to really manifest itself at kind of maybe the beginning of a period that's more inflationary, like the 70s. Certainly that's what a lot of people are concerned about. So that's the perspective. One perspective from the UDPI is just to get an idea of where the risk level is and where it compares to historical levels. It makes total sense that we got a correction from here, just given how overextended we were. Not to say that it had to happen immediately like here, but it did. which again is not unexpected because we've seen this many times in the past. And what I want to do next is flip over to the price chart here and just take a look at the current drawdown and then compare it to the drawdowns we've seen at those times that I identified as being potentially, particularly relevant to where we are right now. And so you can see is that right now we've had a drawdown of around about 21% is around about the max drawdown that we've seen in this current correction that we're in. Let's zoom all the way back. This is the monthly chart I'm showing you, by the way. And I should have mentioned the UDPI analysis I did was also on the monthly chart. Let's look back here at some of those earlier times. Here's the late 50s going into the 60s. These are the bunny hills that we had identified kind of on that UDPI chart, where it's flashing, red back down to yellow or orange, red, yellow, or orange. That in some ways look familiar where we were now, going from orange up to red. Maybe this type of action might fall out from here. And so what we can see, though, is that if we just look at the types of corrections that we saw during that period, what we've seen so far is more or less in line with what we might have expected. 21%. This one was a little bit shorter, only 15%, 30%, 23%. So really, we're kind of maybe at the shorter end of the fall, the less extreme end of the correction, but in line with the kind of action that we saw back in this time in the stock market. Now, of course, if we switch over to the times during the 70s when early 60s going into the 70s when inflation was really a problem and it really started to take off, we start seeing deeper corrections in the stock market here. Really, partially being because, especially as we got into, started getting into the 80s, the Fed got really aggressive with their monetary policy, got really hawkish, trying to bring inflation down by really trying to pull back demand. And that could be partly why we're seeing such steep corrections in risk assets, because essentially they were bringing on recessions to bring down inflation. But certainly what we're seeing here is in line. And so if we're looking for a bottoming out point, just looking at this, if we're just taking these raw numbers, it's not to say that 21% is necessarily a likely bottom, right? There certainly could be more room to fall. But if we do find a bottom somewhere in this range, it could be consistent with this type of action. And it's very possible then that what we could see from here is something that's not totally dissimilar from here. But again, that's obviously a little bit questionable. That's a very speculative thing, because again, just because this played out this way in the past doesn't necessarily mean it would do this again in the future. But just one kind of past example that from the UDPI's perspective looks not totally dissimilar from where we are now. Now, I think what more people are worried about is this type of event here, right, where we see these 50% drawdowns. And I think what a lot of people have been looking at, because these are the more recent kind of massive stock market crashes or bear markets that we've seen more recently, is the 2000 crash and the 2008 crash being 50 and 58% respectively. And one of the things that a lot of people are saying, the more kind of bearish people, is they're expecting this to happen again. They're expecting us to be able to continue falling all the way down to at least let's say 50%. So basically bring us more or less back in line with the bottom of the March 2020 crash. And though that could certainly happen, I do think it's also just important to note that in prior kind of crashes or bear markets, you don't necessarily have to go that far, right? We've seen in the past times when you can find a bottom quite a bit sooner and then have decent upside move from that. Now, the other thing that's important to note when we're looking back at these prior corrections is that they take place over a long period of time. Remember, this is the monthly chart. So we just chart out the number of bars before we start really moving back up. This can be over a year of downside in the stock market, and that's not uncommon. A lot of these corrections that we see are at least a year, if not more. This one was maybe more like 10 months before we started seeing more upside, so a little less than a year. But this one here, this kind of 36% move down, this was getting closer to 2 years before we started seeing moves back to the upside. And that's one thing that's important to keep in mind, is that even if we might have to spend a lot more time moving down, first of all, if we're going to follow some of those earlier trajectories. Just looking at where we are now, we're in month 5 of this this correction in the stock market. We just project that down to 10, that's going to be all the way in November of this year, and it could stretch into next year if those are any indication. But the positive sign of it is, we just go back and look at some of these periods. When you get a rip up in the stock market like this, the thing about crypto is that crypto is a lot more volatile in the stock market, right? If you have oops, wrong tool there. If you have a sustained period of, almost 2 years of the stock market moving up, during that time, the crypto markets can go absolutely ballistic. And we've seen that in the past, right? Just going in 1 year in 2017, seeing this continue rally in the stock market. Arguably the crypto market was really began rallying earlier than that. The crypto market put in a crazy parabolic move during this year here while the stock market was moving up. And so that was, that move was around a year. We can see that if we look at some of these past rallies coming out of these bearish periods, those are going to be more than a year, up to 2 years coming out of that. So that's kind of one of the benefits of crypto, is that it doesn't necessarily need a super long time of bullish macro conditions, or at least bullish stock market action, for it to put in massive moves to the upside. And so even if we do have to spend more time correcting the stock market from here, even if that means more pain in the crypto market from there, if we can at least get a relief rally or a move up, and especially if we're clearing a new all-time highs like we saw back in those examples in the 60s, that would be plenty of time for the crypto market to put in a massive bull run of its own, or maybe there'd be that next stock market crash, which would then obviously bring down the crypto market with it. So what's the kind of the outlook here then, given what we've seen more recently with the news about inflation? So one of the things that came out today that was quite unfortunate, I don't think really many people, well, those who were, kind of are bearish and have bearish bets placed, probably were happy about this, but most of us were not happy to see inflation actually break expectations. Expectations were, I think, 8.3%. The May CPI came out at 8.6%, which is actually even higher than the March CPI print, which is not what people want to see. A lot of people were hoping to see peak inflation get more locked in, which then might suggest that the Fed doesn't need to get as hawkish as they might be. But with this kind of print coming out, it seems more and more likely the Fed is just going to become increasingly hawkish, at least through the rest of the year. And so this is one reason why people are concerned. And we certainly saw, if we just go back to stock market and just flip back to the daily chart here, the stock market really did not like this news, right? See this massive gap down here, this big crash down, with seeming very plausible that we're just going to break down below these lows and continue moving down further off of this bearish news here. And so I think when we think about what we've been talking about, we kind of put it all together. We know that we were in a pretty high risk point back in late 2021 and going into 2022. We know that we were up at around a 4 risk. And so a correction from there was very possible and frankly, in some ways expected. It was not surprising at all to see this happen off of that level. And I think what we're going to have to be watching for then is, do we get more of this kind of action where we end up finding our bottom at a higher risk level, so maybe 1 or 0, which might still suggest we have more room, to fall to get to those levels? Or is this going to become a more protracted thing where we have to dip down into some of these negative UDPI values like back in the 70s, or these crashes that we saw over here before finding a bottom? And I also think, though, it's useful to know that if we do see price action that's more like this, that follows from where we are right now, there could be these periods that give crypto a ton of leeway to run. And that's one thing that's, I think, important to note, is that it's not guaranteed we're going to see this type of eventuality. And if we don't, even if we have to endure more pain throughout the end of the year, that could just set us up for a big rip if the stock market is also moving up. So those are just some things that I'm thinking about, looking at the risk in the stock market, and then also just comparing some of these different corrections we've seen in the past. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. Put a lot of updates about our indicators and more over there.